Good evening, everybody, and welcome to this discussion on startup valuation in Africa. I'd like to thank you very much for joining me. My name is Toby Davis, and I'm an advocate for the African early stage entrepreneurship ecosystem. I'm an angel investor with a growing portfolio of Nigerian early stage tech ventures, and the ones in brackets are the ones that took investment but no longer exist. I keep them up there to remind myself and others of what angel investing is all about. I am a co-founder of the Lagos Angel Network. I'm president of the African Business Angel Network. I'm also a board member of the World Business Angels Forum and the Global Business Angel Network, GBAN. So I'd like to believe that maybe, just maybe, I know one or two things about angel investing, and I'm hoping I can share some of that with you this evening. Well, when we talk about African startup funding, which is what this is all about at the end of the day, it really kicked off when Toby Shapshak in 2015 helped us notice that we passed the $100 million investment mark in African startups. The interesting thing is the following year, according to Partech, that number doubled. By 2017, it went up by another 50%. By 2018, it was just breaking records up to the point of last year where it broke as many records as you care to shake a stick at. I mean, take a look at the top 10 deals last year. The top one, InterSwitch, at 200 million in 2019 exceeded the total investment we had in 2015. So that sort of gives you the context of what we're talking about today. But then we got to be careful. COVID hit us, and by everybody's estimation, investing is sort of going to go down this year a bit. We've seen a slowdown, but it's still happening. Deals are being closed. That is for sure. So what are we going to be talking about today? Well, first of all, I'm going to talk about why startups have value in the first place. We'll look at some terms and definitions, nothing heavy, just a couple of them to get us going. We'll look at pre and post money valuation. We'll actually look at valuation itself. What is it? We'll look at the challenges associated with valuation and some of the solutions that angels and early stage investors have come up with. Then, of course, rites of passage, we will take a look at a few valuation methods. We'll look at some of the pre-revenue ones and some of the post-revenue ones, and we'll look at the pros and cons of each of them and why they can be useful. Then we'll settle down and look at what Alina and others have to say about venture investing through African eyes. We'll talk a bit about the valuation discounts of Africa. And finally, I will share why I think investment stage is actually the key to understanding valuation. So why are startups having value? What is that about? Well, it's because you actually, as a startup builder, you're building a money-making machine. What do I mean by that? Well, it takes in a cash investment and multiplies it and then gives it back to you in return. So this machine has value because of the things that are in it. The more things in the machine, the more its value increases. So for example, if you've got a strong management team, if you add that to the machine, what's going to happen? The machine is going to grow in value. Similarly, if there's intellectual property that's properly protected that you throw into that, the value is going to increase. But the challenge is the fact that doing this is not cheap. Hiring great talent and all of that can be quite expensive. So what tends to happen is after the founders have tapped into all their personal savings and they've managed to get dad, mom, uncle, aunt, or whoever else in the family has got deep pockets to help out, they get some fans, they get friends, and some would say they even get fools on board. What happens? Well, they still need more money, and then they come looking for people like yours truly and others who are these early stage investors to offer them a deal. Offer them a deal? Well, the deal goes something like this. If you give me X million to build my startup, you will get Y% of everything that comes out of it. Remember, I said it's a money-making machine. So as whatever's coming out, you're buying a percentage of that. The question then becomes, all right, if I've been given X, I know I want to invest 20 million naira, how much should I get of that money-making machine? Well, you see, that's where the challenge begins. It depends on the value of the startup right at the time that you're investing. Here's the challenge. That's why we're all listening today. Okay, pre-money valuation is tricky. Okay, before we get into the meat and bones, let's look at some terms and definitions. The first is the investment term. Okay, that's just how long they keep your money for. If you put money in a startup, how long are they keeping it? 5 years, 8 years, whatever it is, how long it's in there. And that helps us determine terminal value, which is going to become important as we go along. Next thing is dilution. That is what happens to your share percentage ownership when new shares are issued. Essentially, if you don't buy more of the new shares and you just keep what you have, the percentage you own drops a bit, and that's dilution for you. A round is a series of investments that actually raise the capital for the startup right at the beginning. We start from actually pre-seed, and then the seed round is actually the first set of external investments in which people like ourselves come in. And it varies. You'll see it anywhere from, in fact, as low as $100,000 all the way up to $500,000. Now, pre or post money valuation, what you need to remember is the pre-money valuation plus the money you're putting in, the investment amount today, is going to give you the post-money valuation. So pre-money valuation is the valuation of the startup before including the funding from the current investment round. And the post-money valuation is the valuation of the startup, including the funding from the current investment round. So for example, if you're raising 100,000 at a 1 million pre-money valuation, that means that your post-money is 1.1 million because you add the 1 million to the 100K. But let's say, for example, you are selling 10% of a 2 million post-money valuation, then that means you're actually raising 200K, which is 10% of the 2 million, and that puts your pre-money valuation at the 200K taken out of the 2 million to give you 1.8 million. So people tend to ask, okay, yeah, pre-money, post-money, which is the better one? Should I go for pre-money or should I go for post-money? Well, neither of them is good or bad, but you just need to know, okay, upfront, how to calculate what you own. Let me give you an example. If a startup's raising, say, 400K at a 1.6 million pre-money valuation, you decide, yeah, you're an angel, here's my 10K in ordinary shares. How much of that company do you own? Well, the first thing is you've got to determine the post-money. That's the 1.6 pre-money valuation plus the 400 you're putting in that was coming in with your round to get 2 million. Then you take your 10K and you divide it by the 2 million and you own 0.5% of that company because at pre-money, it was 1.6, post-money, it's 2 million. You put in 10 and that's how you arrive at it. Now, let's take a look at what would have happened if that 400K was being raised at a 1.6 million post-money. Then what would you do? Well, you just take your 10K divided by the 1.6 because that's the post-money valuation now, and that would give you 0.625%, essentially 25% more than the pre-money. So the key thing to remember is that your ownership as an investor is always based on the post-money valuation. It's the valuation after your money's been taken. That is the key thing to remember. So what exactly is valuation? Well, if we were going to put it simply, it's really the present market value that the founders and the investor agree on. That's it. That essentially is the bottom line. What makes it tricky? Well, first of all, it depends on quite a number of factors, and that's what we're going to be talking about throughout. It's actually those factors that determine the valuation. What are these factors? Well, first is founders. Okay, are they passionate? Are they curious? Are they high flyers? What kind of people are they? What's their execution background and their potential capability? What's the team they've got working with them like? Can the team deliver? Can they do what they're saying? Where in this life cycle of a startup is this particular company at this point in time? Are they still gearing? Do they have customers? Are they in growth? What industry? Is the industry shrinking? What potential does it have going forward? What kind of customers do they have? What's the competition like for them? Is it one that can eat them up? And do they have any intellectual property? Are they having traction and growth in their revenue? What kind of sales are they doing and what kind of margins are they enjoying? What are the risks? And even most importantly, how many investors are in the neighborhood who are, chasing this kind of deal? There's tons and tons and tons much more. But, essentially, for me, the way to look at this is you are trying to get a line, okay, where two things meet. There's the investor's demand curve, which is I have this amount of cash that I would like to own a percentage. Remember the percentages? Yeah, I'd want a bigger percentage and smaller cash. On the other hand, the entrepreneur wants a smaller percentage and bigger cash. So that gives us this implied valuation line. And if you remember what I said at the beginning, what is valuation? It is the present market value as agreed being the operative by the founders and the investors. What do they agree the amount and what is the agreed equity? And that, ladies and gentlemen, is what valuation really is. So what are the challenges? Well, first thing is there just aren't any precise valuations. You start on this journey and you're going to very, very quickly discover that yes, you can use all that. I'm going to share some of the methodologies, but there isn't one, this is the actual value. So you've got to come to an informed judgment at some point. The second is to even help that judgment, there isn't that much information around. And that's one of the things I'm hoping today I can help shape is the fact that we just don't have the numbers because people aren't telling us. And there aren't that many deals that people are aware of. So how do you mitigate against that? The first thing is you've got to practice multiple methodologies. You've got to use different types of methods to arrive at some number, okay, that you can live in. But bottom line, you really, really need to understand is it's whatever else is agreed. That is what the market valuation is at the end of the day. It is what is agreed. So I did talk about methods, and there are, I'm not covering all the methods here. First disclaimer, there are so many methods out there. It is untrue. There are some more simplistic than the ones I'll share, and there are some more complex, but these are the ones I have found or I've played with at one point or the other, because I got too excited. I went all the way to first Chicago or whatever, but these are sort of the ones we know, so to speak. So in pre-revenue, you've got the Berkus method, you've got the scorecard method, there's the risk factor summation and venture capital. I'll talk about those. And then for post-revenue, we'll talk about DCF, the discounted cash flow. We'll talk about comparable precedent transactions, and we'll look at first Chicago before we move on. So jumping in straight away, the Berkus method is actually by Dave Berkus. He's an angel's god, so to speak. And essentially what he does in the method is you attribute a dollar range to a set of values, and there are 5 of them that he's defined. And in his case, he's assigned $500,000 to each of those 5 to make a maximum of 2.5. But he's also allowed that for other markets and other conditions, you could reduce that. So instead of going for 2.5, you could be 250K each for 1.25. These are the 5. So it says if you have a sound idea, okay, that is the basic value, anywhere up to $500,000 or 20% of the benchmark, which in our case would be 250K. Prototype, that reduces the technology risk associated with the startup. Again, the same thing. A quality management team, which means, yes, you're showing the ability to execute. And then strategic relationships that tells you that they can actually get the product service into market. And finally, the product rollout or sales also contribute to this. And you assign the value to each of those. You add that together, and there you go, is your pre-money valuation. The great thing about this is it's quick, it's high level, and you don't need any forecasts. The challenge is all 5 areas are the same in terms of importance, and you really got to know what you're doing, okay, to know how much to give credit to in which area. And it does ignore some of the areas of the more detailed methods. In fact, 2 that I'm going to talk about following. And probably most importantly, because I want to pause on this, it depends on choosing a benchmark for startup valuation. So you've got to know what that benchmark is. What are you measuring against? This is an important recurring theme um, that actually gives powers to angels more than they tend to recognize. Let's continue. The scorecard valuation method, we also know it as the bill pay method. For those of you who don't know Bill Pay is another god of angel investing. I mean, he's been at it like forever. And really, this one says to start again, it's back to that base valuation for your startup of any that were averagely funded, recently funded. And then you adjust the value using a certain set of criteria. This time, there are 7 of them. So you look at the strength of the management team and you benchmark it against what you believe the industry standard is and award a percentile. The beauty of it is you look at the size of the opportunity, the products and technology. You look at the competitive environment. Remember Berkus? Okay, we look at marketing, sales channels, and you look at the need for additional investments. Now, in all of this, you are dealing with weighted, excuse me, you're dealing with weighted percentiles. So whatever you assign, let's say, for example, need for additional investments is 100%, they're going to need additional investment. You have to multiply that by the weight to get the numbers you are actually after. Now, the thing about the scorecard method is it's got more areas than the Berkus method. It's still relatively easy and straightforward. And why we particularly like it is it weighs each area differently, which is why it's a method of choice for many angel investors. The cons, it requires skill to know how much to credit each area. Is it the strength of the team or the stage of the product or service development? You know, those kind of skills are required. And it does ignore some areas. We'll talk about that a bit more. And again, there's this dependency on you having a benchmark, having a rough idea of what, you know, this kind of startup should be worth. Next up is the risk factor summation method that actually came out of the Ohio Tech Angels. And like the scorecard method and even the Berkus, again, it's about valuations similar to the business you are looking at and what they've gone on. So first is you have to determine that initial value for your startup based on the average value of one or more similar startups in the area. Then you start to look at it and you look at critical areas and you adjust from a from a -2 all the way to a +2. And it sounds difficult, but here's what it is. There are 12 areas you look at. So if you look at the management team, for example, if they are really, really strong, they get stronger than what you'd meet in the market, then they get a +2. If the competition risk, for example, is significantly high, then guess what happens? You get a -2. And you go through that with your base valuation, adding or subtracting for each one, the 500K, and guess what? You then get a number. Good thing about it, takes into consideration much, much more, 12 as opposed to the 7 in scorecard and 5 in Berkus. But again, it weighs all the areas as being equally important. And more importantly, it only looks at things that could, you know, that could go wrong. So from that standpoint, and the fact that it does require skills also, and more importantly, again and again, it depends on choosing the appropriate benchmark. If you don't get that first benchmark right, So I hope you're getting a sense here of what you need to do to be able to get accurate valuations. The last of the lot is the VC method, and the VC method really turns things on its head. It borrows from Stephen Covey that says, begin with the end in mind, and says, well, you know what, I'm going to get an eventual selling price of the startup, say when I'm exiting 5 years, 7 years, or 10 years from now. And I know what I'm expecting. I want 20x ROI, and then I'm going to divide that to arrive at it. So what you do is you estimate the terminal value first. Of course, you've got to look around and find out what other things others have sold for and what they're likely to sell for. Then you know what you're expecting. I quite like the 20x. And based on these two elements, you get your post-money valuation, which is the terminal value that you've arrived at, divided by the exit multiple. Your pre-money is then just the post-money, taking away the amount you're about to be investing in this particular round. You've got to note, that dilution can kick in, so you've got to allow for dilution to get a final pre-money valuation when you use the VC method. VC method is very useful for calculating required valuations for pre-revenue startups. The thing though is it doesn't look at each of the aspects, and again, it's depending on you choosing an accurate terminal value. You get the terminal value wrong, you're probably going to lose that particular valuation. So those are the pre-revenue methods. We've talked about Berkus, the scorecard, we've looked at risk factor summation, and we've looked at venture capital. Now let's look at the post-revenue valuation methodologies. First up being the discounted cash flow. The discounted cash flow has a basic principle that says, you know what, if I'm putting in it, it's coming back out. And it's that simple inflow, outflow methodology, adding a discount to the value of money, because the money I give you today is worth much more than the money in the future, and there's a dependency on that. And then what DCF does is it derives the value by estimating those future inflows. The yearly cash flows, once they've been estimated, okay, are then added together. The expectation, of course, is that this company is going to make money and you're going to get much, much, much more out than you put in. There's actually a formula for this that says DCF is equal to the sum of the cash flows divided by 1 plus the discount rate. The discount rate, of course, is the weighted average cost of capital in the prevailing environment. And the R, of course, is the investment term, which I talked about when we did definitions, if you remember. So discounted cash flow, well, you can calculate the present value of a startup based on future cash flows. That makes it so easy to do. But like anything to do with numbers, garbage in, garbage out. And it's only as accurate as the future cash flows you assume. It's highly, highly speculative a few years beyond. And really speaking, it's more for more mature businesses that have at least a couple of, if not 3 years or more worth of track record in terms of cash inflows. So the comparable precedent transactions method, easiest way to think about this is it's just like real estate. So if you're going to buy a 3-bedroom home in Bel Air, you look at what 3-bedroom homes in Bel Air have sold for. And if it's going to be a factory in Kuala Lumpur, you look for what factories in Kuala Lumpur have gone for. And that's, you'll be looking at the numbers specific to that particular industry. So if you take software as a service, for example, it will be monthly recurring revenues, HR headcounts as interims. If you're looking at retail, it could be number of outlets. If you're looking at Meditech, for example, or biotech, it could be patents filed. If you're looking at messengers, it could be weekly active users. The key thing is to pick numbers that you can easily find available is the first thing, but more importantly, resonate exactly with where you're trying to invest. Once you are set on this journey, the first thing is you select the universe of comparable acquisitions. That's what else has happened in this space that I can do. Then you find the information. If you're on Forbes, Bloomberg, Reuters, or anywhere that kind of information, then it's easy. Otherwise, you have to dig into Google, work out the numbers to make sure that you have like-for-like comparatives. And then finally, you determine your valuation and output. Now, the good news about the comparable precedent is you're really looking at like-for-like KPIs, so you can get a better feel than the other methods. And it also doesn't rely on the founder's projections, so you aren't taking into consideration, though, outcomes that may be determined by this particular car, such as if it has an amazing team, it won't count in this particular model. Last up is the First Chicago method, and that actually came out of the late First Chicago Bank. And what it does is it takes 3 different future scenarios. So it takes the worst scenario, what we call a normal case scenario, and then of course the best case scenario, And in each of these, you do like you're doing in VC method, you go for a terminal value. So for each of those, you determine the terminal value, if it's best case, worst case, and there are ways to do that. Then you determine the required return, and then you calculate the valuation for each scenario. If you remember how we did that, you can use DCF if you want. Once you've done that, then you want to go through a mental process of what is the likelihood of occurrence of each of these particular scenarios. Once you've done that, you then weigh each valuation based on that. And what you end up with is a valuation that's highly sophisticated, extremely detailed and thorough. It considers many, many different outcomes, and it accounts for the black swans, which is highly unlikely but high impact situations. Unfortunately, like everything else, it is garbage in, garbage out. It is complex and time intensive, even for sophisticated angels. I will confess, I have only tried this method twice. First time, unsuccessful. Second time, you know. And it does require an intimate knowledge and details of the startup in question for you to be able to use it properly. So those are, oh, by the way, yes, it is not applicable for pre-revenue. This is really post-revenue, as I said earlier. Those are the methods. Those are the traditional tried and tested methods used by angel investors all over the world and continue to be put in use. But I wanted, to take us through some of the thinking that I resonate with in terms of venture investing on the continent itself. The first is the size of rounds, okay? There are smaller rounds by the fact that we've got everything from FX complexities to deal flow. Second is the fact that this allows, okay, the market, for startups to actually test, find their way, know what they're doing, show they've got the stuff. And it also minimizes dilution. And more importantly for me, it is the fact that it helps to establish a disciplined company culture. Now, yes, there may be some of you in the US listening in on this and saying, whoa, small investment rounds, you guys must be joking. Well, these things come from the fact that African economies are high friction environments, okay? Whether you're talking of capital, business, any kind of infrastructure is not readily available, and our currencies are less stable, and the economies are more often exposed to shocks. So if you look at my home country, Nigeria, for example, yes, we're fighting on COVID-19, but we're also going through the shock of the decline in oil prices. And then again, Africa is not one country, it's actually 55 sovereign countries. Okay, the markets are small, they're fragmented, and they're extremely diverse in terms of the needs and preferences that the customers in each of these markets have. And finally, really, to scale fast, as I said to somebody earlier today, you're going to hire fast as well. And we know what the situation is when it comes to talent on the continent. So unfortunately, scaling becomes a challenge. Now, all of these, and the fact that there's very little data available on exits anyway, means that there's some kind of risk profile or risk premium associated with Africa. Nobody's been able to say exactly what it is. I mean, the best person to take a crack at it was in 2013 when Aboyaji said that African discount is at 25%. Advising startups, keep your valuation well under $1 million. That's a laugh now, but it's not as much as a laugh when you realize that raising $10 million of Series A funding, which to their credit, Helium Health did, okay, they had to come out and say, yes, startups must apply an African discount when fundraising. And if you think this is history, no, this was just last month that this was said. So the African valuation discount is alive and well, but the question then becomes, what's really African? Is it when Flutterwave, who's also San Francisco based, raises $35 million in round B? Or is it when Boat, that's Estonian based, okay, raises money to operate in Africa? How about Opay, that got the funding from the Chinese? Or do we talk about the fact that Andela, with its last $100 million raise, is now valued at anywhere from 600 to 700 million. Or the saw in everybody's eyes, do we talk about Jumia? So we need to really question ourselves about what we mean when we talk about African startups. Personally, I liken to Switch as our first African unicorn. So that is where I stand on that. And it's about remembering that this is a journey. Startups start with a great idea when they're incubated and they start to look for minimum viable product. At that time, they are doing pre-seed raising. They mature to finding the minimum viable product and they start looking for product market fit, which is more repeat customers and starting to see strengthening revenues. At that stage, they're probably raising seed. Somewhere in between, they may break even, but as they get traction, then they can get growth funding. By the time they're unit profitable or they actually want to scale, you're talking of Series A and Series B and beyond. And as you can see from the last slide, yes, we are seeing those deals. But what I'm saying to people is, in terms of the value, you need to be conscious of what stage any of these startups are. And if they don't fall into scale, you need to ask questions. We just finished doing a deal that put a startup at $2 million, but they had less than $100,000 in annual revenue. I had to question that particular transaction, but by the time we scratched the surface, we found that it had an amazingly excellent execution team and a leadership team that was driving it, and that was what was responsible for that particular valuation. So again, what this is just a guide that enables you to ask questions, or remember, all the methodologies require that base, that start point for you to be able to do your valuation well. You can take a guide, sort of a midpoint in this, or cater for your particular locale by actually discounting or premiuming what is on this particular table. So finally, well, early stage startups in Africa offer great opportunities, but they carry various risks, which are really, really hard to calculate. Best practice, as I've told you, is for early stage investing to use multiple valuation methods for establishing the pre-money valuation for the startup company. The most important thing, and this is where I think angels need to stand up and be counted, is local knowledge is a critical premium when arriving at valuations. Okay, you value too high, as some of my international friends have been doing. When it comes to the next round, don't be surprised if it's a flat or down round. You value too low, and then of course somebody has taken some of what you should have as the upside. Using multiple methods will also, when you're looking at a startup, it's going to help you in terms of preparing for the term sheet negotiations, especially here now that we're starting to see safes and we're starting to see KISS and a few other instruments that are not, they're sort of convertible equity, for the want of a better word. But last thing is, precision is not the issue. So don't even spend a minute worrying about, oh, is it 5,540,000 or 5,800,000, and no. Don't spend your time on that. You just want to get into the ballpark, and that will do you just fine. As my friend Mbwana Ali says, well, valuations are perceived until they are actually realized. Ladies and gentlemen, I'd like to thank you very much for listening. And at this point, if you'd be kind enough to put your questions into chat, I'll be sure to take them. Wow, okay. Right, going to the top of chat. Audio is fine. Sorry, guys. Okay. I don't see any questions other than one that says, will these slides be available? Yes, they will. Just pop my one email. Given the differences among countries, does the premium vary? Yes, we believe so. We see more money going into what we call now the quadrangle, which is Cairo, Lagos, Nairobi, and Joburg, Cape Town, than anywhere else. What's the most amount of equity you'd recommend to a startup to give out on the first fundraising stage? 10%. What is your own opinion of the African discount? I believe it's necessary. It's unnecessary simply because if we look at the economies of places like the United States, it's 1 point something trillion. I believe the African economy is nowhere near that. So if you look at the economic value, then the discount makes sense. What's the most equity you recommend done given the differences among countries? Yes. How do you encourage Africans to invest locally in their own startups? Please, if you're listening, and if you don't have an angel network in your city, get one. Okay. Angel investing is about building our cities for the future. That's really what the bottom line of it is about. So if you don't have one, you need to sort of charge and challenge the people, the high net worth individuals in your city to start one. If they've got a chamber of commerce, then they can have an angel network. Do you find that valuation of startups in Nigeria inflated based on? Yes, Nigerian, we've had what we call the international influence on valuations, and that continues to happen. It will unfortunately continue as long as the locals don't rise up, to meet the ticket sizes. If the money is coming from outside, which it is in the case of Y Combinator, Textiles, and others, then they will determine the valuation. Most startups are heavily funded by non-Africans. Yep, that's a key issue. What would you say has been the challenges for African startups to raise funding? What are the challenges? It's just, first and foremost, it's a communication thing. There aren't startups. A lot of SMEs think they're startups, so there's a lot of noise. So you get a lot of founders who don't have the prerequisite growth. They're not innovating in the proper space, and the market they're attacking is not large enough, yet they clutter the space with pitches and so on. And that is why startups have the challenges they do. Could you share your experience of your non-tech startup valuations? This applies across the piece. How much detail is required in terms of company info? Does a typical angel ask for pre-revenue? Again, these are very specific questions. If there are details that I cannot answer here, please, Mayowa has pasted her email address. Feel free to send her an email and we'll follow up with you. Which method is peculiar for Africa? The methods I have laid out there, the 5 are the ones we tend to use here. Others, and there are quite a number of others I've not covered here today. I know of at least 14 different valuation methodologies. Can you share your view on rounds B, SB, and European? The pros and cons of having international-led rounds is the fact that they may not understand the local terrain, and then therefore they are not in a position to empathize when things go wrong. For example, international investors could not understand why a state government would ban ride-hailing and get away with it, as Lagos State did earlier this year. That kind of knowledge, those of us local would have known. Well, we knew in advance, and that's why you find the ones that have survived are the ones that have local investors on their boards. You do need that local content. I can't overemphasize it. Does valuation also depend on competition? Of course, it's one of the factors. If you remember at the beginning, that was one of the things I listed as a critical factor. How do I get investment for my startup when my company is not yet registered? Why would anybody invest in an unregistered idea when execution, is the multiplier for ideas? I'm sorry, sir. I don't know how to do that. What is your African discount number? I don't have one. I do it on a case-by-case basis because, again, it's part of valuation and it depends on, how that particular startup has hedged. What would you, so if you take Flutterwave, for example, that's why they're in San Francisco. That commands a premium automatically from anybody else. What would you say about open innovation acceleration in Africa and what to consider for valuation? If I understood what it meant, then I'd probably have an opinion. Unfortunately, sir, I don't. Thomas Bamifewe. Maybe you can educate me by email. I'd really appreciate knowing more and therefore being able to. I intend to conduct a research on overcoming capital raising finance challenges for startups in Ghana. What would be your advice on areas to look for? I would look at the literacy of local investors. There are local investors because you can see they fund buildings and they fund markets. When I say markets, I mean trade. Those are two things you'll find in all African cities. What unfortunately they don't understand is intellectual property and intellectual property investment, especially when it comes to the digital age. So the best thing to do is to find means and ways to educate them so that they can compete, or else the international people will put us into neo-colonization. Do we have closed deals confirming the discount rate of Africa by higher returns? Yes, look at Jumia. How do you assess the startup team? Oh, that's easy. We have a course on that, and there are others that have courses on that too. Where can we get these slides? Mayowa has sent you her email. Please, can you kindly make the recording available? If somebody would offer to edit it, because you'll have this Q&A and all the stuff in front. If I can get somebody that's going to offer to help me edit it and return it clean, then the answer is yes, I will make it available. Otherwise, unfortunately, it is beyond my team's current competence. What is your perspective on incubators or accelerators that are run by nonprofits rather than successful entrepreneurs? Let's have a session on that one. And I would suggest you put that challenge to the Innovation Support Network as one of the topics to be discussed at the gathering. Okay. What are your thoughts on startups raising convertible or safe notes instead of equity rounds? Okay, nice one. When I started on this journey, I used to do equity rounds. Then for 3 years, people were disappearing with my money and not reporting back. Then Egosa Omogwe of EcoBC shared the knowledge of convertible notes with us. And we started doing convertibles and people started reporting regularly because it was a debt. And that's why till today we do convertibles. Safes for me are convertibles without coupons. I don't like them. I don't think they protect the investor enough, but they are becoming fashionable. We'll see. What is your perspective on incubators or accelerators that are run by nonprofits rather than successful entrepreneurs? It depends on the purpose of the incubator or the accelerator. Like I said earlier, angel investing, just like entrepreneur support organizations, are a development asset class. So there needs that you will not find anybody, for example, giving you money to do angel investing. Just like it's unlikely to get money to do an incubator. These are things that the perception is should be done either as pure economic development or by those who can afford to do it. Is there a database of transactions, comparable valuations? I wish there was. We're in the process of creating one. Ask me 3 years from now. How do I increase sales of my products to maintain sustainability? Hire a sales consultant or business development consultant that knows what they're doing, and they will analyze it and let you know. Okay, somebody's offered to edit, so it looks like this will be made available. What is the success rate of crowdfunding? I don't know, crowdfunding. It's what I think, if you find out anything about crowdfunding, especially here in Nigeria, please, td@tbcng.com, share it with me. I'd like to know. It sounds like there are two African valuation markets, either 100% local business, a business with a footprint in Silicon Valley or elsewhere. Do you agree that these are two distinct worlds, or how would you describe the difference you alluded to? No, they're complex and multiple variate worlds. So first of all, you have what we call the Delaware corporations. These are what happens when any of the American investors come in. They ask you to form a Delaware corporation, and that's how they invest in you. Silicon Valley people included. So that's sort of the first. To do the equivalent for Africa, they ask you to do Mauritius or Seychelles. In Europe, it's, oh my God, it'll come to me. It's a tiny little, I was going to say Luxembourg, that's it. It's Luxembourg. So you have these cities that have very relaxed tax, countries, very relaxed, and in the case of the US states, very relaxed laws around uh, corporate registration, but they have amazing transparency, and that's why people use them. What are some guidance you would recommend for startups doing convertible rounds? I would not do a convertible without a cap. So the first thing is go and determine what that cap should be. Then the term of the convertible, I like 36 months to a max of 60. So that's 3 to 5 years because it keeps you honest. In terms of discount rates, I really don't care anymore because safes are out now. Anything above inflation is fine in terms of discount rate. Discount rate in a convertible is the interest rate. Oh, sorry, discount rate. Sorry, I was taught coupon rate. Discount rate will vary on time. If it's 3 years, then you're probably looking at 20. If it's 5, it's 25. In terms of interest rates, it's that is the coupon rate you're talking about. In that case, we are looking at, as I said, inflation rate. What is your take on revenue-based funding? Well, if you have enough margins to do it, then that is every startup's dream. I think I have answered about all the questions, and I've still managed to retain everybody here. Oof. Now, what type of funding would you advise startups at pre-seed and seed to position themselves to aside bootstrapping? Angel. Go find angels who have access to follow-on investment. That's what you want to do, especially if they have knowledge of the space in which you're working. Yep, that is it. That is it. How do we solve the problem of skills for a tech startup? Well, that's why Andela was created. That's why Decagon exists. That's what Semicolon is trying to address. We recognize that it's a challenge, and there are startups who are playing to try and address that space. So I would say hook up with Semicolon. I would say that because I'm an advisor, an investor in Semicolon, so they're my first choice. But there's also Decagon, and of course, if you have the deep pockets, there's Andela. What are the best angel networks in Africa? Oh, what? Yeah, what are the best angel networks in Africa? I don't know how you define best, okay, because it depends on what you mean by best. I can tell you the most proficient in terms of prolific angel networks are the Cairo Angels, you've got the Josie Angels, you've got the Lagos Angels, you've got Southeast Angels, you've got the Victoria Angels. Sorry, Victoria Angels are in Nairobi, Kenya. Southeast Angels are in Port Harcourt, Nigeria. Cairo Angels are in Cairo, Egypt. Lagos Angels are in Lagos, Nigeria. Josie Angels are in Johannesburg. Then you've got Rising Tide Africa, which is also a Lagos-based female-only network. So it does vary, depends on what you're looking at. How would an angel or follow-on investors feel about a startup with 3-year convertible on their cap table? A 3-year convertible, how can a convertible be on the cap table? Cap table is shareholders. It will show up as a loan. It will show up as a liability, not on the cap table. Remember that a convertible note is an option to convert. Okay, do you see funding available for regulated industries like healthcare that require a lot more pre-revenue funding? Yes, if you look at MDAS that was invested in by Ventures Platform, that's medical devices as a service, they're getting funded. If you look at GeroCare, which is also a remote geriatric care management system, they're getting funded. So the answer is yes. I think I found my initial research on startup challenges to raise the funding is inadequate traction. What would be your advice for startups on how they can create traction, especially before MVP? If you haven't read it already and you don't own a copy, go and get Eric Ries's Lean Startup Machine. It takes you through the iterative process of product development, okay, where you build, measure, learn. And you go through that cycle, pivoting at the right time to face the right opportunities. That is what I believe every single person looking for MVP should be using, especially in the crazy environment that lacks infrastructure like we do here in Nigeria or the African continent. Okay, how do we solve the problem of trust with trust with startups in e-commerce in Africa? Again, e-commerce in Africa is an oxymoron. Okay, we don't produce the things we're selling, so there's a whole issue around the whole e-commerce thing. But to address the issue of trust, it's because we haven't built the right trust systems yet. And I believe as we move more and more towards crypto and other types of currency, we will start to see trust premiums placed on certain currencies, just like we do it with the US dollar today, where we place a trust premium on the US dollar as opposed to, let's say, the CFA or the Naira. Please, is it possible to get recording and slides? That's already been talked about. Eric Rees, Lean Startup, yes. What do you think about an edtech that just launched looking to raise funding? Tough times, very, very tough times. I would say it depends what the edtech is doing. ULesson by Sim Shagaya is an edtech that's doing amazingly well, and it's raised, I think, $2 or $3 million already. It's still gangbusters. I have an edtech that is doing really, really, great things. FlexiSav to the point that, please don't quote me on this yet. We're umming and ahhing about listing. So yes, there's funding out there for edtech. Now, I think the next question somebody asked me is, okay, is LAN still active? I think is the next question. And if I could, is LAN still active? I want something to everyone. How do I say everyone? Oh well, there's a link to the latest deal that LAN has done that has just been sent. I think that answers that. Rather than saying yes or no, I've sent you a link to the latest deal so you can see what they've invested in, and that should answer your question. What are your thoughts, opinions about loyalty systems in Africa? The West understands and uses them as a tool for customer retention. Do you think it would work? I know of about 3 loyalty startups so far that have failed on this continent. Well, in fact, in Nigeria, not on the continent. I believe somebody may yet get it right, but they're going to need AI and all kinds of stuff to help them on that road. What about EdTech with adaptive learning? What about it? Which is the easiest African country to get funding from? It depends on which African country you yourself are from. If you're a Nigerian going to South Africa to raise funding, you'll have challenges. Just like if you're a South African going to Egypt to raise funding, you have challenges. But if you're an Egyptian trying to raise money in Egypt, then it's relatively decent. I mean, you see them, they've probably done the most number of deals in the last 3 years when it comes to angel networks. So in terms of easy, looking at Cairo is 100 million, Egypt is 100 million, Nigeria is nearly 200 million, etc. Looking at all of those numbers, you'd say yes, Egypt is relatively easier, but if you're in Nigeria, I wish you all the best trying to raise. Do you believe it's possible to hire the best talent in countries that do not allow for employee stock options? There are ways around that. But the answer is technically yes. If you want real talent, then it's not about the paycheck, it's about ownership. What is your advice for e-commerce startups to scale up so Amazon and the others are not dominant on the African space? I don't care. I really and honestly do not care. I want the most efficient service provider, okay, to do us proud. And I believe, just so you're aware, that there are those who are going to wipe the floor with Amazon in some spaces, and there are those that Amazon is going to have no choice but to acquire. What do you think angels think about the largely informal regulated transportation industry in Africa? It's funny that I'm actually looking at a transaction in that space as we speak. Yeah. Okay, ladies and gentlemen, it's 5 minutes to the hour. I hope everybody has found it useful. And before I bring the hour to a close, I would like to ask if there are any last questions. Okay. Well, I'd like to say thank you very much for staying with me for the hour. I hope you found it useful. Mayowa.alamu@tvcng.com. She's put her email in. Please pop her an email if you need anything whatsoever from us. I very, very much appreciate you all. Have a great day. Bye-bye. Oops, I forgot the survey. If you're still listening, please do me a favor, do the survey. Please, please, please. Thank you. Oh, thank you very much. Please, okay, my team's going to beat me up if you don't do the survey.